listen-only mode.
Good afternoon, everybody. This is Stan and Jack, and we're here for a special webinar on reversal patterns. And we're going to be talking about identifying and trading reversal patterns. It's a classical technical analysis technique, and Jack is going to be leading this webinar, and I'm going to be adding examples in color and talking about how to trade reversal patterns. So I think that's the agenda for today, and our disclaimer. We do everything we do on the Art of Chart for educational purposes only. Nothing that we do here is about issuing trading signals, okay? So we hope that you benefit from this in terms of learning something about technical analysis and how to use it in trading. So with that said, Jack, are you ready to begin?
Yeah, start out.
All right, here we go. I think you wanted to talk about indexes and also silver and a few other things.
Yeah. I've got quite a number.
And by the way, everybody, if you have questions along the way, put them in the questions tab and we'll get to them.
Yep. All right. Now, I'm going to show some historic examples today and various instruments. There's that one on the yen I called in 2012. There's an interesting setup on silver I'd like to talk about. For now, I'm going to start, though, with one of the absolute classics. And this is the chart for 1980 to 88. Sorry, end of 88 on SPX, and it encompasses, of course, the 87 crash. Now, this is like the current bull market. This was made up of more than one main pattern. Here you've got the initial move up. You've actually got the low here, so 1, 2, and you've got an initial pattern here, which is a rising wedge. That rising wedge breaks up. I think actually that's exactly what happened on SPX midway through this particular bull market as well. And then you get the pattern for that move up there, gets to the top. But this is one of the reasons I love this chart is because there's just the pure mathematical beauty of the trend lines. I mean, it's just lovely the way it works. I mean, here you've got. I mean, all the stuff about, the 87 crash was, totally chaotic. It's garbage. The speed of it was unexpected. The rest of it was, honestly, matched up with obvious areas on the charts, and actually forms an overall pattern here. Because what you've got is these are the smaller patterns within the larger pattern. The larger pattern is a rising megaphone. Top trend line there. Bottom trend line there. You've got the rising wedge, breaks up, never in doubt, and breaks up into a rising megaphone. That actually overthrows slightly at the high and hits rising resistance from this level here and forms the upper level of the overall rising megaphone. You then break down almost to megaphone support and then it gaps through it. That's a very, very strong way to break a pattern, as long as the gap doesn't fill, which it didn't. It's well, not until the low, obviously. It comes down and then touches rising support from 1982. Comes down, obvious area, rises from there, makes new high, and so on. This is a lovely. I mean, admittedly, for anyone who's starting to build a long position early at this above this trend line here, obviously the large gap down came as an extremely nasty shock. But the fact is, this megaphone, that was I've actually drawn this in. It was a beautiful Fibonacci retracement as well, 50%. Anyway, I digress. But I just wanted to show this one. What were the topping patterns on here? Well, at the top in 1987, what have you got here? You've got an overthrow of the megaphone. Because you've got a clear pattern here, and you've got an overthrow, which immediately alerts you to the fact that it may be about to break down, because generally speaking, that's what an overthrow will mean. If you get a decline from there, it will generally break the supporting trend line, and that's why, of course, people shouldn't have been legging in long at the trend line, because the trend line wasn't likely to hold. So you get the move up, you get the top, you get down, you get a retest. In this case, it's a lower high. Often it would be a higher high, but reasonably close. I mean, I think the technical rule is within 3%, so it doesn't need to look. It doesn't need to be exact. It doesn't need to be close to exact, but it needs to be, a reasonable attempt at retesting the high, which isn't too far below or too far above. It's rule of thumb would be 3% in this particular case. How would that fit? Right, we've got 337, we've got 329. That's actually about 2.75%, I think. So that's a reasonable fit. And then you've got the breakthrough, and then your double top plays out. It makes target above the trend line, and obviously there's a possibility it might bounce there, but then it moves down. How do you recognize the bottoming pattern? So that was a clear topping pattern, and anyone who was surprised by the decline here shouldn't have been really. These are weekly charts, by the way, so you can appreciate quite how fast that move was. That's 1 week, that's 2 weeks, that's 3 weeks. Wow. It's anyway, you get turned to the bottom, and again, it's pretty routine. You come down, get a large bounce, you come down, you make a marginal lower low, and there you have your double bottom setup. Now, it takes a while to play out, but it makes target, breaks up, and sort of does this sort of zigzaggy thing up for months, and then makes target in 89. Again, pretty routine stuff. Now, I've mentioned on my blog before that probably 3/4 of all the topping and bottoming patterns on SPX are double tops or double bottoms. Now, and therefore you always need to be prepared for the retest. And actually, that's what we're looking at now. We were forming a head and shoulders, and here we are, and we're about to retest the high. It could go higher. And I was putting a channel out this morning, and as long as that channel holds, and of course if it breaks, then the bull scenario is off. But as long as that channel holds, then it could be signaling that we're in an impulse wave up. So we'll obviously watching that with interest. Anyway, so that is double top 1, double top 2. Patterns give you a lot of the clues here. The clue that a pattern was likely to form here came with the overthrow of the trend line, and then you form your classic double top. And anyone who didn't expect this move down really wasn't paying attention, because they really should have expected it, especially with that's a huge weekly divergence. It was coming. So, and of course it goes to the Fibonacci 50% retracement. This is just a lovely, lovely chart. Now, just something more topical. Let's have a look at the silver chart. Now this is, hang on a second, it's just, sorry, I was editing it. And in a moment it's going to bring my trend lines back. Ah, there they are, right. Sorry, they've only just introduced this actually. I'm not entirely comfortable with the new editing method, but it works okay. Now, this is the silver chart, and I really should have been paying more attention to this in recent weeks, because this is really telling a story. This is obviously a rising megaphone from the low. And this is, and this was not at all clear on the gold chart, but this is both an island top, currently unfilled, although we do have, this is a 60-minute chart, and we do have a 60-minute buy signal here.
And silver is such a great corollary with gold, because gold is an emotional instrument, where silver, I think it's more technically viable in terms of what you can take from silver versus what's happening with gold.
But equally, I mean, you can look at the GDX chart and the silver chart, and you can get insights from about the precious metals market that you can't get from elsewhere. I made a mistake here. I was watching the silver chart, but not the silver chart. And actually, I'd have been rather better off watching this chart, because this tells a very clear story. Rising megaphone from the low. Nice high there. I mean, that's unconfirmed until, because obviously it's got a reasonable anchor there, but it's unconfirmed until you get the decline, because we got the decline. You've got rising support. I've marked that in, but that's coming up through here. That breaks. At that stage, you're looking for a reversal pattern to form, and it's a very clear head and shoulder pattern. Left shoulder, head, right shoulder, and then gaps down through it, and you're off to the races. Yep. We're in a bounce mode at the moment. There's obviously more downside coming, or at least there's likely to be. And if this island top doesn't fill, then that could be serious. Do we have an overthrow? No, we don't, or at least not one that's easily identifiable. Hang on, I'll just throw this into edit mode, because that is actually at least fairly easy on the new format. Now let's have a quick look. Let's draw in a trend line here. This would be the ideal anchor. Ooh. Ah. Okay, that may have been an overthrow. Look at it. You've got this is a lovely, this is an ideal anchor for a trend line. Very nice clear high. You've got 1, 2. You've got an overthrow through it, and then comes back
test. Yeah, nice.
That's nice. That's really nice. I think that may be telling us that silver's about to break down from this megaphone. In which case, that's going to be an interesting. I mean, that fits with the sell signals I've been getting on gold, and they haven't made target yet. I think this SLV chart's telling us that we need to be much more bearish on precious metals, and that's a beautiful line on top. This is actually a lovely technical chart.
Yeah,
really nice. So anyway, so we're seeing that. We may actually also be forming. Is one thing you often see, and just taking you back to the A7 chart for a moment. One thing you often see is multiple patterns. For instance, you can't really see it in the detail here, but there's most likely a little double top here. That little double top takes you down to here. You get a little double bottom you can see here, and that takes you up to the retest. Falls a bit short, so that doesn't actually quite make target. So there probably would have been some disappointed longs at this stage when it started, when it fell off the cliff. But it fails to make target, fails hard. And off it goes. But you often get these multiple sets, and when I'm talking about them, in a post or on a chart or something, I'm describing them as nested patterns, nested double tops, nested head and shoulder patterns. It's a larger one within a smaller one. Let's see if I can find one of those here on silver. Nope, can't see one. But anyway, this is. You've got a decline here, very clear inverted head and shoulder pattern breaks up. Yeah, you've got a new trend starts, megaphone forms, that megaphone has overthrown, that's the correct trend line, I'm sure of it. In which case that is leaning towards a breakdown from here. But again, you overthrow it and then you have a nice head and shoulders form and it breaks down. Could that fail here? Yes. Is there any reason really to think it will? On this chart, no. There's no reason to think that won't make target. So
great.
Yeah, we'll see how that goes. I think, but that is the way that you identify these patterns. If you look at the overall pattern structure, you look at broken trend lines, and when you see broken trend lines, you start looking around for the patterns.
Right. I have a reversal pattern and an example in terms of how to trade it whenever you're ready.
Yeah, throw your bet screen.
Yeah, whenever you're ready. I had a sense you were coming to conclusion on the silver chart. I didn't know if you were finished quite yet.
Yeah, I was.
Okay.
Yeah,
good.
That was a topical one because it's always nice to do topical ones because people are trading them. So.
Okay. The reversal pattern I want to talk about is a flat. Now, these occur a lot, and you'll see them a lot in bearish markets, and bearish trends or bearish markets. And by the way, they're upside down. So this is in a bullish market. You would basically take these and invert them. So, a flat that we're currently looking at in the S&Ps is this one here on the bottom. This is an expanded flat. You have a 3 down, you got a 3 up, higher than the origination point, and then a 5 down, okay? Now turn this upside down, and that's kind of what we're looking at right now on the S&P. So, we have this 5 down formation that's actually now 5 up, okay? Now, if you're, and by the way, I consider this a reversal pattern because flats reverse. And typically you get the end of a move, especially in a bearish trend, off of a flat. Okay, so let's look at the S&Ps for a moment and just understand what I'm talking about. So here is a W, okay, which is 100% fib. It came straight down into 2040 on the S&Ps. Okay, so here we have a 3 up for an A. Here's a 3 down, very obvious, right to the 100% fib, right to 2030, 2028. We called this beautifully. And there is the B. And now we have a 5 up. Now, one of the ways you can tell if you're in a flat, and it's a little late sometimes when you see this, did everybody see this impulse right here? It's a pretty much in-your-face, no retracement, just trend days, basically, back to back, okay? And now we're in this little sideways consolidation period, which, by the way, this little sideways thing, it looks like a triangle to me, okay? And we're not into triangles, and triangles are not a reversal pattern, they're a continuation pattern, okay? So, for me, the 618 of this move is up here at 2101. I also have another fib that says 2099, and I'm looking for resistance right there. The monthly R1 is just above, okay? So let's make the assumption that, and by the way, as a trader, you always have to know how much your risk is and what you're willing to risk on a reversal pattern. Now, this is my interpretation, right? And there's a possible reversal pattern here, and here's my number, right? Okay, where's my invalidation? Well, it's above this number here. So my invalidation is 2111, okay? So what would I do to trade this? Well, right now what I would do is I would wait for a break of the trend line because I could be wrong. A scenario where I could be wrong is we could do this, down to the monthly, down to the weekly and bounce maybe, or we could go straight down, whatever. But I think market direction is important for you to have in mind, not necessarily the target. Okay, target isn't important in trading, market direction is. So, for me, I might be on a break of this trend line looking to get in short, right? I'm not putting anything on short yet now that I have this pattern recognized. I'd wait for up here. I'd put on a portion of a position, maybe half size, okay? And I'd hold and I'd wait for perhaps resistance up here at 2106, okay? And I'd put on another half. But then if I break my invalidation level, I'm out of the trade. The real hard part about reversal patterns, and this is something I just want to say, trading is not 100% science, okay? If I get it right 70% of the time, I'm just so delighted, okay, absolutely delighted if I'm right 70% of the time. So, I put something on up here, and by the way, I'll make sure that this is not going to be a major loss in my portfolio. I'm not putting on 50% size on a reversal pattern, okay? I'll wait for the confirmation, as Jack said, the lower high. I'll wait for the lower high and I'll put more on, okay? But at this moment in time, I don't want to try to pick a top or pick a bottom. I think that's where traders make a lot of mistakes in trading the market. Okay, you have a box, you have a theory, like we had a theory here, it would reverse, and we said we expect immediate downside. Okay, it worked, right? Great, wonderful. We said the same thing here. Hey, it worked too. It doesn't mean it's going to work here again, guys. It doesn't. So, I have to approach the market managing my risk. I'm going to put on a partial position. I'm going to put on a little bit more higher. And then if I go through my invalidation area, I'm out of the trade. And so you always have to know where your invalidation level is on a reversal pattern. If you're expecting a reversal and you're just putting size on or money on without an invalidation level, you're not managing risk well. So in terms of trading invalidation, in terms of trading reversal patterns, I really want to emphasize that as a very important thing. Okay, so that's my example, Jack. I wanted to throw that out there as a, and it's kind of current. It's kind of like right now. So hopefully that's useful to folks. Oh, and I'm sorry. One other thing about reversal patterns, and Jack is an expert on RSI, but in a 5-up pattern like this, I'm expecting a lower high in RSI, and so I would be expecting, like tomorrow, something like that, where we're a lower high, maybe even we finish at the high tomorrow. Okay, that would really scare the hell out of the bears, So a lower high would be just gorgeous if we see it. Now, obviously, if we break this high, okay, this one here, the 2111, the invalidation level, that divergence is more than likely it's going to go away. Okay, so you got to see both sides of the market. I still believe this is a reversal pattern. I still believe we're heading lower. It's just a matter of us finishing out this pattern. It's an A, B. Here's your W, X, Y, X. X looks done to me, by the way. Z. Okay, or if you are more the traditional Elliott, the A, B, 1, 2, 3, 4, and 5. So we'll see what happens tomorrow, and so that's my little thing on trading reversal patterns. Do you have another one, Jack, you want to go over?
I do. I'm going to talk about bonds.
Okay, great. Here we go. You got it.
Right. Now, yeah. Okay.
And guys,
right, now,
if folks have any questions, go ahead and post them, and we'll deal with them at the end.
Yep. Now, just going to show some of the long-term bonds charts. When I say long-term, this is this particular one. Data starts in 62. So these are. You really need something of this size to actually show the length of bull and buy markets on bonds. I mean, this is the bear market in bond yields, i.e. bull market in bonds, from the high in 1981. And in equities, you might find a bull market lasts 3 years, might last 5, might last 7 or 8. They don't last decades. This lasts decades. You can get what you call a secular market can last decades. Although in practical terms, actually, you generally find that's a couple of decades up, and then less than a year down. Really, for the secular bears, I think, if you look at them properly. But anyway, here is the huge bear market. Starts off at this is interest rates of almost 16%. In 1981, and down to the stage where they're just giving cartloads of money away. It's at the moment. This is, what are we looking for in terms of reversal patterns here? Well, this was the support trend line, nice and clear, but by the time this broke, obviously we already had a topping pattern here. That topping pattern was a head and shoulder pattern. I've marked in the arrows for it, but it's very clear. You've got the nice two shoulders. You don't always get them at the same height, but they should be at a fairly similar height ideally. This is a model example. And you've got upsloping neckline. Shoulders is about the same level, which regardless of the upsloping neckline is supposed to be the case. You've got a nice support trend line, shorter term support trend line here, and you get the last spikes up. You break through it, you break back up through it, you make the right shoulder, and then you fail. And really, this is the stage where you'd have been seriously looking at shorts, because you got a nice pattern here, and really you're looking at a break down here, let's say 10%, and it's targeting 4%. It takes a long time to reach it, but remember, of course, if you were going long bonds, i.e. short yields, long bonds, all you had to do actually was buy long bonds. People who bought the 30-year bonds in 1981 just made out like bandits. They made a fortune. Held them till maturity, made a mint. Anyway, so that is, what are we looking for here? Well, I think we're pretty much reaching rock bottom. What are we looking for here in terms of reversal pattern? This is the candidate double bottom setup that we've been watching really form for years and been writing about for a long time. Let's have a look at that on TYX, which is the 30-year Treasury. Now, obviously, the 30-year Treasury yields. Now, again, got a very nice. It goes back. The data goes back a bit further. You can see the beautiful support trend line here, which breaks down into the long bear market in bond yields. But you can see you've already got a double bottom that's formed here. And what's this? It's another smaller one. This is the moment is nested double bottoms. This is actually a set of 3. You've got the first one here, then you've got a second smaller one, and you've got a third little small one. And this is I did a post a few months ago showing a set like this, calling it the 3 bears. So I think those were all double tops. But you will often see that. And really, what we're coming in for now, I think, is going to be the final retest, final test of the lows, and then it should start playing out. Why do we think it's going to play out? Well, there's a number of things on different markets. Correlated markets, always worth watching. I posted this in February last year, and again, we've been looking for a reversal pattern on here, and we've got it. So this was the lifetime rising megaphone on TLT. I posted the chart, I think, the day after it hit this high here, saying this was an enormously important point on TLT, and we could be looking at a high level which wouldn't be more than tested as part of a topping pattern for many years. And what have we done from there? Well, we've come down and we've formed a lovely double top. I think that double top may well play out. It could go a bit higher. Might evolve into a head and shoulders or something. But I think at the moment we've come back, we've made a very marginal higher high. This is a lovely looking double top. And I think what I'm really thinking here is that we'll probably go back and retest this high, maybe do a little higher again. And that gives us nested double tops good to go, and I think it may well fail there. We shall see. I think if it goes higher, it should stay within this trend line here, I think. That's, and you can see that if this double top plays out and makes target, it's going to break the overall pattern, rising megaphone, and that rising megaphone, the full target will be down here, down in the 60 area. Now that seems like an awfully long way down, but the fact is actually when you consider that we would be moving from a bear market in bond yields to a bull market in bond yields, which could be reasonably expected to last a couple of decades again. You can see this one here this was the last bull market in bond yields. It lasted the thick end of 40 years. That's a very long time. Realistically, I mean, if we're right about this, then we're looking at highs being made in bonds that we're not actually likely to see again in our lifetimes, because we might need to live another 70 to 90 years to see them again. It's going to be a very, very interesting development, and this is going to change the world as we see it, because actually an awful lot of the policies you see at the moment in terms of QE and so on are all based on an assumption that low interest rates will be lasting indefinitely.
Yeah,
I don't think
that's certainly not the case. That's for sure.
It's at the end of the day, they probably thought that here too. But you know.
So I'm sorry, Jack.
Sure.
I was going to say we have a question. Are you ready for questions?
Yeah.
Okay. There's a question here from Stan, and Stan, I just have a clarifying question. You said something about where might your stop be in terms of trading a reversal pattern, and you said the recent run-up. So are you talking about the S&Ps, or are you talking about the E-mini? If you can just be clear about that, that would be helpful. Okay, SPX. Were you finished with bonds, Jack?
Yeah, sure. I'll throw it back.
Okay, great. Let me share with you, Stan, the E-mini, and there's a dangerous thing here that I just want to say. I don't know what size your portfolio is. I don't know what size position you have on. So you know, it's a difficult question to answer. But let me say this. I think Stan is asking, where would your stop be? And his example is he entered a short maybe back here. Okay, so you know, you see this double top sort of formation right here, and you say, hey, we're going to go lower. Well, that's actually a pretty good call because we did, but it didn't last. Okay, and I wanted to introduce this system for those of you who may not be familiar with it. Okay, so the way that I like to try to trade is I look for back tests of swing. So the last swing is this swing here, and what I would do, especially entering a market like this, is you look at the 50% back position and you exit part of your trade. You move your stop to even. Okay, so whatever the last swing is, you take some off after you pass the 50% back area. And the only reason I share this is a lot of people don't really exit trades or leg in and leg out. So, you know, one way to really help yourself in your trading is if you are wrong, at least you get a third of your position off and you move your stop to even and you get stopped out. So one stop strategy, Stan, is when you enter a position, look at the last swing, 50% back, get out of a portion, a third or something, and if it goes against you with your stop at even, you've lost nothing. Okay, now let's assume that you've taken nothing off, and let's assume that you've ridden this whole thing up. Okay, now again, what I'm about to say is going to depend upon your portfolio and how much size you have on now. I would wait until we get up into this area, like the 90, 95 area. Again, what I said on the S&Ps, here's a W, here's my interpretation, and my interpretation could be wrong. Here's the W, here's the A, here's the B, here's the 1, 2, 3. We're putting in a triangle, A, B, C, D. We need an E and a thrust. The thrust could go to 95. It could go to 2102. Okay. Now, what I would do is I would wait until we go a little bit higher. I'd put some additional risk on to bring your average up. Okay. Now, what you want to do is you want to make sure your average is above what area? Let me just show you this. Using my system, I would say I'd want my average to be above 2071. Okay, and I would expect the market to come back to 2071 at a minimum. Frankly, the market may go a bit deeper than that. So, you know, in my view of the market, 2071 would be the 50 back. We take off a third, put our stop to even, wherever that is, and see what happens. Okay, and if it continues lower, great. If there's going to be a reversal in the market, my take, it's going to come from 64s. Okay. So if we are going to go higher, we're not going to go much higher. We'll see 64s and then a run higher. Okay, so be careful. Be careful here. And the other stop, of course, is if we break above 2102 with any force, I'd get out of the position entirely and just call it a loser and move on. And all you have as a trader is your next trade. So again, back to the S&P 500. Again, we break this high here. That's your stop, 2111. I'd add size here if you're already short at bringing up your average. Bring it up above this monthly pivot. Monthly pivot here is 2070 on the S&Ps. 2070 is where we could get a bounce higher in a bullish market. I don't believe this is a bullish market. I believe we're going to go lower, but you have to look at both sides and manage your position accordingly. So I hope that helps in terms of trading a reversal pattern, which is what I think we're in right now anyway. So answer that question, Jack. Any other comments about managing a short that you're already in right now?
What, from me?
Yeah. That's basically
no, really. I think that covers it. No, I think that covers it.
Okay, very good. Anything else, Jack, from you on reversal patterns?
Yeah, I've got more to show.
Okay, let me share the screen with you again, and let's see. I don't have any more questions, but if people have them, ask, and we'll deal with it.
Right, I'm just going to show a couple of yen charts because again it's of immediate relevance. Because I did a big post on this, and we've got multiple time frames here to consider. Now this is one I called in 2012. Now yen, you tend to get very nice patterns on, nice clear resistance trend line, nice wedge, and you get the first breakdown. Now that's your first warning that the wedge is going to break down. And you're looking for a reversal pattern. It was pretty obvious what the reversal pattern might be at that stage. We were either going to go back and retest the high for a double top, or we were going to do a head and shoulder pattern. If we were going to do a head and shoulder pattern, I often mention the ideal high would be at for a right shoulder. Here, of course, what have we got? A spike up here to 128.79, and this one's at 129.65. Nice, well-balanced head and shoulder pattern, and I called it short when it made the second break through wedge support. So at that stage, it was likely to go through here, and at that stage, you're on the way down. So I called it short, and then very gratifyingly, it just collapsed over the next few months, which was very nice. Anyway, the thought process, I also posted me talking about this last year, and this, of course, it had formed a falling wedge on the way down. It was a nice, clear falling wedge, and we hadn't actually broken up from it, I don't think, at that stage, but we were obviously running out of wedge. We'd also reached, these are areas where you should be looking, you see. This was a good area to be looking for a topping pattern, and it was there, and it was very tradable. This was an area to start looking around for a bottoming pattern. Why? We were running out of wedge, so it was likely to break one way or the other fairly soon. We'd also made the full target on this rising wedge. The full target for a rising wedge is a retracement back to the beginning, and we'd made that target. That was 80.55, and we made it down to 79.46. At that stage, I was looking around. So I was talking about if there was a break, there might be an inverted head and shoulders forming, and that's exactly what we saw. And that broke up, and actually, that pretty much exactly made target. Now, flashing forward to the present day, I then posted this, and at the time I posted this, I think the yen was about here, but I was talking about a likely reversal. Why was that? Well, we were in a clear rising wedge, we had a beautiful resistance trend line, and we just hit it. We could have overthrown, yes, but actually I wasn't assuming that we would actually break down from there. There was no strong indication to suggest that we would. I was just suggesting that we were due for a return to wedge support. Now it's actually returned there, broken, and retested. What are we looking at here for potential reversal patterns? Well, this is the obvious support area to watch at 89.5. And this could be either double top support with slightly asymmetric one, or potentially it could be a head and shoulder support. So in which case you could come down, make a low at this sort of level, and go up to a right shoulder with an ideal target, ideal high in the 92.36 area. So if you saw that, then that again is eminently tradable, and you could well see that at another retest of the broken support trend line, which is something you will often see. And then if that breaks down, then that would target the you know, so or sort of target this support area here around 85.5. It's at that stage the move might be finished. I'd be running the fibs. If it gets significantly beyond the 61.8% fib retrace, then you've got problems. So really, that's at 86. You wouldn't want to see it trading long before then, because if it does that, then it'll probably do the full retracement. It's in which case the move's probably over, because the yen ultimately is a complete dog.
So let's. I have a question for you, Jack, about double tops or double bottoms in terms of the percentages. So like double tops, double bottoms, what's the percentage that they actually execute? And some patterns are like 50%, some are 75%, some are 66%. And also head and shoulders.
Go on. Yeah.
And also head and shoulders. So it's double bottom, double top, and head and shoulders. That's a question from David. Good question.
The main source of all the statistics on basically all the patterns comes from Bulkowski's site. And his site's called thepatternSite.com. They've got a visual chart pattern index. If you go there, you will find all sorts of useful statistics, and I use it a lot. My understanding of some of these patterns is very different from his. For instance, my rising wedges I interpret very differently in channels and so on and so forth. But basically, that's the essential source for stats that you should be using. For patterns. So it's thepatternSite.com, and it's Thomas Bulkowski's site. He's written a number of books on patterns, and they are the standard works on patterns.
Mm-hmm. Okay. Other questions? I have one other one. He'll catch it later on the recording. He was wondering if you could explain inverted head and shoulders and defining necklines and breakout lines. All right.
Well, I'll go back to the silver chart for that. Now, there's a couple of things to remember with all these things. All these things, there's always something to remember.
Jack, we may have to cut this close. I'm understanding we have a tornado warning in my area.
Okay, I'll be quick. Right. This one here, for instance, you've got a very clear neckline. You've got you're looking for something that looks like a head and shoulders. You need to have distinct shoulders and a head. That head can be complex. No problem at all. But it needs to hang together as a formation. Here you've got a clear left shoulder, and you're looking for a right shoulder to match, and you've got one. Comes through. It's in the right area. It's very distinct. Nicely picked out. So that's your left shoulder, that's your right shoulder. That gives you your neckline, which in this case is upsloping. An inverted head and shoulders is just upside down version. This is an inverted head and shoulders right here, actually. You've got left shoulder, it's a little unbalanced because the right shoulder is smaller. You do get that regularly, still perfectly valid. And this is a nice inverted head and shoulders, which then played out and made target. But you are looking for the reversal setup. This is, a lot of head and shoulders will exhibit a sort of rounding bottom sort of a look, or rounding top, or if they, they can be more spiky. But I mean, these are, once you watch for them and look at a lot of them, you'll learn to recognize them. Now, when it breaks, obviously that's a break under the neckline. Now, one thing I mention regularly is that you are most likely to see the pattern fail just after it's broken the neckline. Mm-hmm. By the time it gets to, let's say, well, here, chances are it's going to make the target. If you're going to see this pattern fail, then you're really looking in this area here. And actually, the head and shoulders we've just seen fail on SPX and RUT particularly. Both failed just after the break of the neckline in this sort of little box here.
Just to say a word about trading that, okay? So any one of those lower highs, you can see them there. Would you trade the 1709? I wouldn't. I would wait for a lower high, and you have one, I count 2, I count 3, I count 4. So you have 4 opportunities to get in there on a lower high versus trying to trade the breakout. I think trading a breakout is higher risk, and you can certainly do it.
It's just there's no setup.
Yeah, I think the setup is.
Why would you go?
Yeah, exactly. And by the way, the only other comment I wanted to make, Jack, is your head and shoulders neckline there, the dotted line. When you break a neckline, guys, everybody else sees it, and everybody else is on board short, and you're going to get a big move down. I mean, that's typical. Yep. So by that time, if I've missed it, I've missed the boat. Okay. Yeah, right, exactly. So, what I'm not going to do is get short lower down there in the, what is it, 15 50 area. So that's like not on. So anyway,
Although,
I'm afraid
there might be an opportunity on a decent bounce here. So you know, if this bounces back up into the 16 area, that's an opportunity to consider it.
that's right. I think necklines often get retested. That's the thing to look for. I think, first of all, we've been at this for about an hour. I need to go here because we're having a pretty heavy electrical storm here. So
Yeah, no worries.
great questions, guys, and great webinar, Jack, and always a pleasure doing it with you.
Always a pleasure, mate.
All right, guys, take care. Trade them well. Bye-bye.
Yes, sir.